Now, parallel to VC funding, startups are looking at venture debt for their capital needs. To understand how this is taking a leap among new age entrepreneurs and why it's becoming an attractive option, Vinod Murli, the managing director at InnoVen Capital, is joining us today. Vinod, great to have you with us in the studio. So tell us, we all about venture debt. I'm going to come, of course, to InnoVen and some of the things that you're looking at currently, but this is a really exciting product, so I want to understand a little bit more about that.
Sure. So venture debt is kind of oxymoronic to an extent because the idea is to give debt to companies which are very early in the life cycle. And these are not situations where traditionally debt is applied or been relevant. So these are non-profitable companies, high growth in sectors which are very, very new. Sectors are seldom understood. And founders who are professionals, so they don't really have family wealth and business connections and so on.
Right.
So none of these are relevant for traditional debt. There's no collateral, it's a new business and so on. So venture debt is, essentially started off as an idea to give these founders an alternative to equity. The only source of capital for them is equity. Can there be a way of providing some money to them and hopefully get it back? And ensure that it's very, very customized, very tailored to the constituency of technology-driven companies. This is how it started in the US. In India, we've kind of broad-based a little bit. So.
And what are the advantages if I go in for debt, over equity, other than the obvious, the fact that you're not giving away equity, but what are some of the other advantages in the way?
The big one is that as a founder, every founder wants to protect their ownership. So the big one is you don't need to dilute as much as you would if you've taken equity. There are other softer advantages, right? You build a track record. As the company grows, you ensure that you're building a debt track record, and eventually you become eligible for bank funding as well. Builds in a little bit of discipline in terms of the financial health of the company as well. But more than anything else, it's about protecting ownership. It gives you an opportunity to protect your stake as a founder.
So what's the kind of timeline you'd have to pay back that debt? What happens if you can't pay it back?
So typical timelines are 2 to 3 years.
Okay.
So that's a little bit of a difference between how a venture capital investor from an equity perspective looks at things. So they look at a 7 to 10 year horizon. We look at a 2 to 3 year horizon. So the idea is to get in, ensure that the company has a little bit of extra runway to raise the next round of capital. Allows them to flex their arms a bit, grow faster, grow better, and then they raise the next round at a better valuation. So if they can't raise the next round of equity, there is a challenge to their ability to repay the debt. And we've seen some of those situations as well. So either we try and work with them to understand if it's a temporary issue where they can get over the line, they need a little bit of time. And that's fine. Or if it's a fundamental issue where the business model doesn't, it's not relevant anymore, then you need to do what is appropriate in that case.
Okay, so how much of the business that you're doing currently, and you have a very wide portfolio, you've been around for a while as well, how much of it do you see now sort of, how many of your customers or partners that you're looking at working with do you see actually going in for this option? It must still be very new, but do you still see it becoming kind of a,
No, it's definitely grown in terms of velocity of transactions. So we've been doing this for about 7.5 years now, since the winter of 2008. This is the best time to start a business, right? So, we started slowly, and one of the issues that we had initially was how to translate this product, which has worked very well in the US, in the Indian environment. So this fundamentally worked on the basis of tech IP, and India is not known for its tech IP. We have a lot of fantastic businesses, but they are largely execution plays. So we took some time to kind of change the thesis and Indianize venture debt to that extent. But with improved awareness, we've ourselves done almost 120 transactions across 80 companies. So there's that many brand ambassadors or ambassadors for a product. So all those founders, have moved on, they've done well, and they speak for us in a sense. So, last year we did almost 30 transactions, and this year I think we'll do more. So there's definitely a much higher velocity in terms of transactions that are getting done, and the market itself is expanding. And venture capital it's become more mainstream, right? So entrepreneurship is more mainstream, which is not the case even 5 years ago. That has helped in improving the quality of founders and companies that we're seeing.
Fantastic. So You've actually been an investor in some of the original, entrepreneurs in the current sort of unicorn club. What have your experiences been like? You've managed some early stage exits as well, so I think you've been well protected.
We were in Snapdeal, we were in Mintra, we were in FreeCharge, so we were lucky to be in some of those exits as they happened. Prism Payments was another one, which eventually got bought by Hitachi. So it's been, we were in the right place at the right time to an extent, so we got lucky. We were also fortunate to work with some of these fantastic entrepreneurs, and we've exited Mintra and FreeCharge as well as Prism, and we continue to do so. So even last year, for example, we had the good fortune to fund companies like Practo and Portia and Byju's and so on. So there's been a constant set of excellent founders who've come by, and we've just gone from one to the other.
I feel that there's been a lot of there have been a lot of trends and a lot of ups and downs when it comes to some of these sectors. For instance, last year, healthcare was all the rage, right? And everyone was going out there and funding a healthcare startup. And today, it's a lot more about fintech, for instance. A lot of those healthcare ones you were talking about have faded into the background. Some are, of course, alive and kicking, but perhaps either not getting as much attention or perhaps struggling to grow as fast. What's the story with you VCs? And
so that's a good question, right? So we have always tried to stay out of the feeding frenzy, and more than anything, it's because it's difficult to understand why some companies are getting money. So last year there was a lot of food tech, there was a lot of home services, and we didn't do a single deal neither. And the reason was when 15 companies get funded in a space, it's difficult to ascertain who's really good and who's getting money because there's a lot of supply. So today the market is very different. Fintech is a space that we've been interested in. In fact, our first deal was Prism, which was an ATM management company, and that provided us an exit as well. But it's also been a very difficult segment to understand who's going to be sustainable. The technology obsolescence is very rapid. There's a lot of variables at play, and so we've been more cautious on that one. We've seen a kind of resurgence of B2B companies, so we're seeing a lot more interest in that segment. The B2C companies get a lot of the headlines. They're more seen in the customer end, they're more visible, they have the big billboards, and they run ad campaigns as well. But the B2B companies keep chugging along, and almost 40-50% of our portfolio over time has been towards B2B companies. They just don't get talked about as much.
I do agree. We have had a few, of course, on Rising Stars, and they have been very interesting, but I agree. Let's also get your take on how you feel the ecosystem has evolved in the last 8 years. There's just been so much that's happened, and as you know, a lot of the hype has been VC driven. I'm not attacking you, but it's true. Over the last couple of years. I want to get a sense, from you. If I were an entrepreneur today and I was trying to kind of navigate my way through this maze, how are things different than they were if I'd been approaching an investor 5 years ago?
The first thing is it's a much better environment to be an entrepreneur. It's more embracing, and as a society, I think India has now come to a point where nobody questions you saying, okay, you're an entrepreneur because you didn't get a job. It's more like you want to be an entrepreneur, and there's a good level of social tag that goes with it. I think that's fundamentally important. A lot of college kids want to become entrepreneurs today, which wasn't the case even a few years ago. So I think to that extent, the goodwill that has been generated is fantastic. The access is pretty high because we have so many layers of digital access that are possible. There's so many vendors, and every investor is looking for the next big startup, right? So I don't think there's any challenge to getting access to the right people, as long as the idea and the team is interesting and the market opportunity is interesting. I think there's always time that is given to such founders. I'm extremely optimistic about where we are, and even though the equity environment has been slightly lukewarm over the last year and a half, I think it's a good recalibration that we needed. Because sometimes what happens is we get carried away, which happened a year and a half ago. There's sudden rush of capital where kind of the tide goes up, but that doesn't mean that it's the best thing for the environment. And today it's a check to see, okay, what are good quality companies supposed to look like? You need to spend the time, round should not be 6 months out, they should be 18 months out, so that companies can deliver on their promises and establish that they're actually increasing in value. And that's what everybody, as a founder, as a stakeholder, as a customer, you want the products to improve, you want companies to scale and raise capital for the right reasons. I think that's happening a lot more now. There's harder questions being asked, but they're also the right questions to be asked. And those who answer the questions are getting the proper capital.
Right. All right, and would you primarily look at early stage investments, or are you looking at investments across the board, or even venture debt across the board?
Yeah, so we look at Series A and beyond, and the idea is to look at companies that raise some form of institutional capital, and we follow on with rounds as well, so it's right from Series A all the way through Series C. The nomenclature in India has kind of taken a beating. I think companies raise 5, 6, 7 rounds. But we look for at least one round of institutional equity to happen before we can evaluate them for venture debt.
Okay, so is there kind of like an average kind of size or of investment that you normally look at?
Yeah, so we've done about 1,100 crore in total, roughly, and it's been around 120 companies. So about 10 crore is our average size.
Okay.
Our range is between $500,000 to about $5 million, but our sweet spot is about, say, 10 to 12 crore.
Awesome. Thank you so much for coming in today. It was great chatting to you and hearing all about what's happening at InnoVen and venture debt. Yet another new